Hello everyone. Today in this lecture we are discussing about pair trading strategies using statistical arbitrage. Pair trading is considered to be one of the most popular form of market neutral trading strategy. In this strategy, usually a pair of stocks is traded in a neutral market such that it doesn't matter whether the market is trending upwards or downwards because of hedging two open positions for each stock against each other. The main challenges in pair trading are to choose a pair which will give you a good statistical arbitrage opportunities over time. Now second, we need to know that what should be the entry or exit points. In statistical arbitrage, statistics plays an important role in deciding whether to trade a pair or not, which is usually selected from the sample stock basket. For example, ACC and Ambuja are on the same sector as well as industry. There are thousands of pairs possible in each domain, but to select the best one are only based on mathematical or statistical tests. We will learn about the statistical methods in the next session of pair trading. Now first, to select a pair, we need to check the correlation between two stocks. Now here, the correlation is quantified by the correlation coefficient, which ranges from -1 to +1. When a perfect positive correlation is that when one stock moves in either up or down direction and the other stock moves in the same direction with the same magnitude, while a perfectly negative correlation is when one stock moves in the upward direction and the other stock moves in the downward direction, that is the opposite direction with same magnitude. Suppose if the correlation between two stocks is high, let's say 0.8, so traders may choose that pair for pair trading. This is high number which represents a strong relationship between two stocks. Based on this assumption, a market neutral strategy is played where stock A is bought and stock B is sold. Basically, it happens because the decisions which are made based on their individual pattern. Now, let's move forward with an example. We consider ACC and Ambuja pair. We implement mean reversion strategy on this pair. Before we move forward, you must know what the mean reversion is. Mean reversion is a property of stationary time series. Since we claim that the pair we have chosen is mean reverting, we should test whether it follows stationary or not. As the trading logic is coded in the cell of the sheet, you can improve your understanding by downloading and analyzing the files at your own convenience. Not just that, you can play around the numbers to obtain the better results. You might find suitable parameters that provides higher profits than this return. There can be many ways of defining to take profits, which is depending on your risk appetite and backtesting result. In this Excel model, it will help you to know about the application of mean reversion, and it will make you clarity of pair trading and how to optimize trading parameters to get a significant return on statistical arbitrage. Now in this sheet of pair trading, now see here in column C, which represents the price of ACC, and in column D, which represents the price of Ambuja. Now we need to check the correlation between these two stocks. Now here we have got the correlation, which signifies that the two stocks are positively correlated. Now let's move forward to column E and F, where we have just find out the log normal return of these two stocks because the stock prices follows log normal distribution. Now if you are doing an arbitrage trade, so the word spread refers to the difference between the closing prices of two stocks. Now here in column G, we have calculated the log A minus log B, where A and B are the prices of ACC and Ambuja respectively. Now in column H, we are calculating the change in spread, and we have to make sure to check the ADF test whether these values are stationary or not. as spread in a time series is tested for stationary by the ADF test. If the pair stock are co-integrated, it suggests that the mean and variance of this correlation remains constant over the time. So we have find out the ADF test. Now next, in column I, we will calculate the moving average of the spread. Now let's move to the next column. The similar logic holds for column J also, where we will calculate the standard deviation of the spread. Now in column K, we need to calculate the Z score. Before that, let me discuss some information about Z score. Before that, you should know what is a Z score and how it is calculated. Now here, in Z score, we are not going to discuss about mathematics. Especially in this strategy of statistical arbitrage, Z score is used to create a threshold labels. Now see here, the spread minus mean of the spread, and we need to divide it by the standard deviation of the spread. So basically the mean and standard deviation can be the rolling statistics for a period of time intervals. It is easy to create threshold labels for this distribution, such as 0.5 sigma, 1 sigma, 1.5 sigma, and so on. Now see here, specially we have decided the threshold as 0.75 sigma. This parameter can be changed as per the backtesting result without risking overfitting to the data. Now in column I, which represents the trading signal, so using moving averages, standard deviation, and Z score, we will create the entry points of this pair trading. As I have mentioned in the input parameter, when Z score crosses upper threshold, that is 0.75, then we will sell SEC and we will buy Ambuja. In similar manner, when the Z score crosses below the threshold, that means negative 0.75, we will buy SEC stock and we will sell Ambuja stock. Now in column M and N, which represents the buying and selling prices. Now look at here, it is important that in column O, which represents the final signal with entry and exit points. That means here we need to define our final entry as well as exit point. That means with target profit and stop loss. Now in column P, which represents the final buy price, please note here that the buying price in the previous column, all the values are changing, but we have all our positions open all the time. So to make the prices fixed as per the trading signal, that's why we have separated the entry price. So similarly in column Q, which represents the final sell prices. Now let's move to column R, where the profit and loss status of the trade. So here profit and loss is calculated only when we have squared up our positions. Now finally in column S, we are calculating the cumulative profit of this trading system. Now see here, the output table has some performance metrics tabulated. So from all loss making trades, we have the 4 lakh something. These are the number of trades where the stop loss got hitted, and the profits from the trade that hits targeted profit is 8,52,000 something. So the total net PNL here we have got is 4,49,000 something. So basically in this strategy, the things that I need to highlight here is that to make a list of pairs which are highly correlated, check whether the pair is co-integrated or not, then decide the time horizon of trade, like whether you want to trade on hour time frame or day time frame or weekly basis. Then you need to calculate the spread ratio and then compute the moving average as well as standard deviation. Subsequently calculate the Z score values for the price ratio of the spread. Now based on the Z score, define the pair's entry point for extreme Z score values. Now if the Z score goes beyond the certain predefined thresholds, then sell the winning stock and buy the losing stock. In this way the strategy work out. Kindly go through all the steps individually. If you have any doubt, please comment on the Q forum box. Thank you.